Hello students, myself Dr. S. Jansirani, Assistant Professor of Commerce from Government City College, Nayapur, Hyderabad. In the earlier class, we have discussed about the how do we prepare trading account, profit and loss account, and balance sheet. And also we have understood what are the different formats or the different methods of preparing the balance sheet under different heads. In that, we have studied horizontal way, vertical way. So three methods of balance sheet we have come across in the earlier class. Now, today's session, we will try to understand about the company accounts and how they are prepared. That is block 2 and chapter 7. And if you look at here, introduction to company accounts. And when we talk about company accounts, because block 2 talks about all preparation of final accounts. Trading account, profit and loss account, and balance sheet together we call it as final accounts. And the main purpose of preparing the final accounts is to know whether any business is earning profit or loss. So what's new to understand about the company accounts? Why? Because there's a lot of difference between the normal final accounts and the company account. There's just slight difference. Why? Because whatever we have studied, it's all about the sole trader form of business where it is suitable. When we come to the company accounts, there are different rules as per Companies Act. So first in this unit, we will study introduction to company accounts about what are shares, different types of companies, debentures, and how do they are issued, different types of debentures, underwriting process. That all will means it's all about theory part. That is unit 7. So if you just look at here, they're given the definition of company as per, actually it was Companies Act 1956, but it has been revived in 2013. So we have Companies Act 2013. As per 1956 Companies Act, it was like this, that a company which is registered as per Companies Act, they're called as joint stock company. But it has been revived as per 2013 Companies Act, and we have different, little slight difference, almost the same. The company means a company which is incorporated under the Act or any previous company law. Means both acts we have 1956 as well as 2013. And essential characters of a company, we have registration. A company should be registered under Companies Act 2013. Separate legal entity means though the owner has started the business, owner and the business are different because it's an artificial person. And perpetual succession or existence means the company will run forever irrespective of the owner is alive or not, because the legal heir will be looking after that. So it will, in the assumption that the business will be carried forever, the company will be started. Transferability of shares, they can be easily transferred through stock exchanges. And it's a limited liability. Why do we call limited liability? Because when we learn the difference between sole proprietor, partnership, and company form, in company form, the shareholders will invest in the company as per the requirement or the number of shares they purchase. Similarly, they will receive the profit as per the number of shares they purchased. And also the loss is also as per the number of shares they purchased, that they have to bear the loss. And the loss will not be extended to sell their personal property. Whereas partnership concern, the partners has to go beyond the business property. They have to even sell their private property to bear the losses. And it's a common sale because their colleges, institutes, universities, some organization, educational institutions, or some companies. How do we recognize? Because of their seal, their stamp. Similarly, the companies will have the common seal, and here there is not the one owner who will look after the business. we have different types of shareholders, and all the shareholders together will but owners will not look after the company. They will hire a director or a management. So management and ownership are different, and these are different kinds of companies. I am not going through the theory part. I will go into the practical part. So we will look after how actually company accounts are prepared. It's all about theory, different types of shares. We have preference shares, equity shares, right shares, and debentures also. We have different types of debentures. Preference shares also, we have different types of preference shares. A types of preference shares we have. Debenture is nothing but is one of the loan that has been taken, and on that interest will be paid to the debenture holders. There is a slight difference between the preference shares and equity shares. For equity shareholder, they are the actual owners. Why? Because at the ending of when company goes into liquidation or winding of the company takes place, in that situation, the first preference will be given to the preference shareholders. That is the reason we call them as preference. Means when the company is going to close, at that period, the first means they will sell the assets and they will repay to the first payment will be done to the preference shareholders. Then if anything is left over, it will be paid to the equity shareholder. This is all about the theory. This is actual one, company's final accounts, how actually the company final accounts are prepared. So this is the format. I hope it's visible to all. This is how we prepare the company balance sheet, company accounts. The same as it is what we have discussed in the final account, that is preparation of balance sheet. It is as it is, only the headings and subtitles changes, but the meaning remains the same. If you can just look at here, the first one is equity and liabilities. Under equity and liabilities, we have shareholders fund, share application money pending allotment, non-current liabilities and current liabilities. See, liabilities means anything the company is due to the outsiders. So in that, the first liability means the first and the company starts its business. They are the owner. Shareholders fund means nothing but the owner's fund. In shareholders fund, what does it include? It includes share capital. Share capital means the capital which has been taken from the shares in the form of shares from the shareholders. Anything invested or purchased the shares by the shareholders is called share capital. Capital means the commencement of business, whatever the amount is invested in the business. Suppose XY Limited wanted to start the business. So how it will be started? They need some monetary thing. The monetary thing is nothing but money. And the money from which they are starting the business we call it as capital. Then what is share capital? Share capital means the total amount, whatever the capital we are calling at the commencement of business, it is required. That capital is divided into small units that we call it as share. Capital divided into small unit, and each unit we call it as share. That whatever amount we are receiving, that we call it as share capital. So it belongs to the shareholders fund. Next, reserves and surplus. Reserves and surplus means any profits, net profit, we get profit in our business, or any reserves we maintain. We maintain reserve to meet the future contingencies. So that reserves and surplus belongs to the shareholders only, means owners. Money received again, share warrants. Any share warrants are issued, and if we receive any money, that also belongs to the shareholder. This is the first heading. Next, we have share application, money pending allotment. Actually, whenever the shares are issued to the public, The company will not ask the shareholders to pay the total amount at a time. It will ask or it will call the shareholders to pay amount in different stages. So the first stage, we call it as share capital. The first stage, we call it as share application. Means whatever amount paid towards the share application is the first stage. Once applications are received, shares will be allotted. That is second stage. Share allotment. Share allotment. Next, after allotting the shares, we will ask them to pay. For example, if the share value of each share is 10 rupees. As a company, I can decide that share application amount will be 5 rupees or 3 rupees. So what I'll do, if 10,000 people are paying, so I'll ask everyone to pay only for share application amount, that is 3 rupees. Next, after 6 months, I need some more capital. I will ask share to whom I have allotted the share. Now I will allot the shares. So 10,000 means I have allotted 8,000 people. So for 8,000 people, I will ask towards share allotment. See, you have been allotted these many shares. A has been allotted 10 shares. B has been allotted 20 shares. Like this, I have allotted. So when allotment, I will ask them to pay towards allotment 2 rupees. So out of 10 rupees, still how much I have collected? I have collected 5 rupees. Now still 5 rupees is pending. Whenever I require, I will ask shareholders to pay the amount. So after share allotment, I will call it as share first call. Share first call. Towards first call, I will ask to pay 2 rupees. Next, if I want like this, it will be continued. How many times I want, I can call. For example, I need next time 1 rupee only. So I'll call share second call. 1 rupee. Now I need total remaining 2 rupees. So I'll call share final call or share third call. Like this, whatever amount I require, only I'll ask, and whenever the company requires, at that time only the shareholders are asked to pay the amount towards the company. So here money share application money pending allotment. So if anything amount is there, that will be written over here. Next, non-current liabilities. Current liabilities means any liability which is payable within a period of 12 months or 1 year. Period of 12 months or 1 year, that are called current liabilities, which can be easily paid within a period of 12 months or 1 year. Non-current liabilities means which are not payable within a period of 12 months or 1 year are called non-current liabilities, like long-term borrowings, deferred tax liabilities. Other long-term liabilities means it may be bank loans, debentures, that all falls under this. Next, current liabilities, short-term borrowings, trade payables, other current liabilities, and short-term provisions. So these are the things which will fall under equity and liabilities. Next we have is assets. So under assets, we have non-current assets and current assets. Now let's see what are the non-current assets. Assets means where others means outsiders are due to the company or payable to the company or which belongs to the company are called assets. And here current assets means which can be easily converted into 12 months or 1 year, means easily converted into what? Easily converted into cash. And non-current assets means which are there with the company and which will give benefit to the company for the longer period. So in non-current assets such as fixed assets, under that again they given tangible, intangible. Tangible means which we can touch, see and feel. For example, building, machinery, land, motor vehicle. This all comes under land premises, furniture, fixtures, equipments, that all comes under tangible assets, which we can touch and see them. And intangible assets means what? The assets which we cannot touch and see. For example, goodwill, intellectual property, copyrights, trademarks, technical know-how, that all comes under intangible assets. But still they have financial or monetary benefit to the organization. Next, capital work in progress, intangible assets under development. Next, we have any non-current investments if you have done, long-term loans and advances given to outsiders, and other non-current assets. Next, we have current assets. Current assets means which can be easily converted into cash, or which we can ask who are due to the company to pay the amount within a period of 12 months or 1 year. We have current investments, inventories. Inventories means nothing but the stock. Next, we have trade receivables, cash and cash equivalents, short-term loans and advances, and other current assets. So this is a format you have to follow. The same thing which we have learned in the earlier class about the balance sheet, but different, the same perspective, but different headings and different positions have been changed. This is the balance sheet has to be prepared as per Companies Act 2013. So that's what they explained here, what comes under what. Current liabilities means any incomes received in advance, unpaid dividends. Tangible assets, land, building, plant, equipment. Intangible assets, goodwill, computer, software, mining rights, copyrights, licenses, trademarks. So these all means each heading you should be able to easily segregate what is current asset, what is non-current asset or fixed asset. And in fixed assets, you should be able to identify what is tangible asset, what is intangible asset. So that segregation has to be done clearly. So this is profit and loss account as per the company's format. Actually, in the earlier class, we have studied profit and loss account in the form of T-shape, where debit, credit, falls, opening stock, closing stock, sales, purchases. But here the format is totally different, but the same meaning comes over here. The first one is revenue from operations, means whatever you sell, that all is nothing but the revenue from operations, and other incomes. Any income that we are getting, that we'll write here. Next, we have that is called total revenue 1 plus 2. And expenses, cost of materials consumed. Material consumed means I said purchases plus opening stock minus closing stock. The same thing they have written here. You can just look at it. Cost of material consumed. Under that, purchases of stock in trade, changes in inventories of finished goods, work in progress, and stock means actually inventory means stock. Stock is of 3 types. I hope you all know that. That is raw material, work in progress, and finished goods. So inventory include these 3 types of stock. One is raw material stock, one is work in progress stock, and the other one is finished goods. Raw material means material required to produce any or manufacture any product. Work in progress means which has been completed raw material position but has not yet completed the finished goods stage. Still it's in process. So here that's what they given. Purchase of stock in trade, changes in inventory of finished goods, work in progress, and stock. Changes in inventory means the difference between opening stock and the closing stock. Here it is. The difference between opening stock and closing stock is nothing but changes in inventories of finished goods, work in progress, and stock in trade. Next, employee benefits, expense, finance cost, depreciation and amortization expenses, and other expenses. Means here we write all direct and indirect expenses such as wages, salaries, insurance, postage, telephone, telegraph, bad debts, traveling expenses, commission, discount allowed. All indirect and direct expenses are written over here, and the total we are calling it as total expenses. Next, we have profits before exceptional and extraordinary items. From that we'll deduct the exceptional items. Next, we have profit before extraordinary items and tax. Extraordinary items, profit before tax. If any tax is there, we deduct it. And profit or loss for the period from continuing operations means anything, whatever we get here, either profit or loss, that we mention over here. From discontinuing operations, tax expense. of discontinuing operations. Discontinuing profit or loss means after deducting these two, that is 12th and 13th, we deduct it, then we get the profit, and this profit is earnings per share. If it is given, we'll calculate, otherwise we'll stop here. Mostly we'll stop here itself. If anything is there, we go ahead. Tax is there, we will calculate, otherwise we'll get the profit after tax. That's it. Or profit before tax. So here again they mention what all actually comes over here. If you can just look at here. Revenue from operations. Here you can see in the format. The first one, revenue from operations. Then revenue from operations means what? Sales. Sales of products or sales of services. It may be anything. Sales of goods or anything. That is called revenue from operations. And in respect of finance company, if it's a finance company, or interest or other financial services. And if you look at your format here, and even they said that finance cost. Finance cost means what all will fall under that. You can just look at it. Interest expense. Anything interest is paid, or borrowing cost, any loan is taken. That all comes under finance cost. And other incomes also given. That is Roman number 2. You can just, if you have textbook, you can just look at there. Other incomes. And other incomes means dividend income. Interest means company is receiving. That all has to be added to the revenue from operations. Then we'll get the total income or total revenue. So what we will do, just we look after the one of the questions, so that it will be easy for you to understand actually how it is done, rather than explaining more of theoretical part. Let's see the one problem. How actually it will begin, how it will be calculated. Let's see that. So here what they given, actually the format we have studied a balance sheet also. The balance sheet, they said that non-current assets. Under that, they given tangible assets and intangible assets. But in the format, we cannot write directly all tangible and intangible assets. That separate schedules. Schedule means separate tables to be prepared, and we have to total up in the working notes. Only there we have to bring it the balance and write it in the format. Just look at it. From the following figures, prepare a company's notes on accounts with respect to its inventories. He's talking only about inventories. Inventory means, I said we have 3 types. What are those inventories? Raw material, work in progress, and finished goods. So here, just look at here. From the following figures, prepare a company's notes on accounts with respect to its inventories as per the Schedule 3, Part 1 of the Companies Act. So just look at here. They're given raw materials to us, work in progress, finished goods, stores and spares, and loose tools. So here we have to find out only the inventories. So raw material is 5 lakhs. And work in progress is 3 lakhs. And finished goods is 6,50,000. So we have what you have, we are going to find out only inventories value. We are going to find only inventories value. So here inventories value. Just look at here. So what raw material, finished goods, and these 3 are stock only. Then stores and spares and loose tools are what? These are also inventories only. Stores and spares, loose tools. For example, stores and spares means we need some screws or something. For example, in order to fix any table, we need nails. Yes, screws we require. We require handles. There are certain material which we cannot see, like such as Fevicol we require, some glue we require, that are within the table, but we cannot see that, but it is a part of inventory. Without the Fevicol, can we make a table? No, it is not possible. Why? Because we have to paste the laminate to the plywood, and we have to do the all the changes, and screws has to be used to fix that table. But it is not possible for us to do without them. So stores and spares and loose tools are also the part of the inventories. So what we will do, we write a table, and in table we write like this. Note 1, particulars, means we are doing, it's only one part of total balance sheet. So only one part, that is only about inventories we are doing, not total balance sheet. And amount in rupees. So under the inventories, first we write inventories, underline. Under that we have raw material, and raw material is 5 lakhs in the amount column. Next we have work in progress, amount column 3 lakhs. We add all these things. Finished goods 6,50,000, and stores 1,50,000, and loose tools 75,000. All together we get 5, 8, 14, 15, 16, 16,75,000. So inventories, what is the value of inventories? 16,75,000. We go to the balance sheet, there we write in the format inventories, that is under current assets. Their inventory 16,75,000. This all cannot be written in the balance sheet. This has to be done separate schedules, means tables we prepare, and we write the answer in the only balance sheet. Now, let's look at the next question for our understanding. Look at here. From the following information of a company other than a finance company, you are asked to prepare the possible notes to accounts as per the Schedule 3, Part 2 of the Companies Act. Schedule 2 is nothing but the profit and loss statement that has to be prepared. And in that we have sales of product 50. So what I do, these 3 zeros will be taken into thousands. So you see, so sales of products, sales of services, turnover, commission, that is operating revenue, excise duty, net income, dividend earned and received, net gain on sale of investments, dividend earned and received, income earned from let out of company's vacant land, out of which rent collection charges were paid to the extent of 1,20,000. Show rupees in thousands only. So thousands means it will be 5 lakhs. 2,40,000. So 3 zeros will be taken into thousands. So what they're asking us to prepare the profit and loss account in the form of form of company's account. So whenever company's account format is asked as, we draw like this. The first column is note 1, note number we write. Next one is particulars. Next one is amount in thousands. So as per the format, the first one is what? Revenue from operations. Means here they're asking only us to find out income, not total profit and loss account. So revenue from operations. So under revenue from operation, what we are selling? We are selling products, we are selling services, yes. And also we are receiving commission on turnover. Turnover means nothing but the sales only. So here sales of products is 5 lakhs. And sales of services is 2,40,000. And turnover commission is 50,000. And if you look at here, we have even excise duty. So from all this income, this excise duty will be deducted. So 5 lakhs, sales of products, and sales of services, it is 2,40,000. And turnover means nothing but commission on sales, total sales. Okay. So commission is 5 lakhs. 5 lakhs? No, 50,000. So it will be 7 lakhs 90,000. From this, we will deduct the excise duty. See, here simple thing is you have to remember or memorize the format. You have to memorize the format. So commission received is, sorry, not commission, excise duty. Less excise duty is nothing but expenditure for the sales purpose. It is 80,000. So 7 lakhs, it will be 7 lakh 10,000. 7 lakh 10,000 is our revenue from operations. And other incomes we have interest earned, net gain on. So these all are incomes. These all will be added and we'll get total revenue. In the profit and loss account, we have written the first two Roman numbers, total revenue 1 plus 2. That is what we are calculating here. That's it. Let's look at the full-fledged problem. Now, one problem we'll look at how actually it is done. Now this one. Yeah, I think this we can do it. Look at the question number 5. From the following information, Chetan Limited, you are required to prepare its profit and loss statement for the year ended 31st March 2000. Here it is not given. Why is that means? I don't know what it is. So 2015 or whatever the year will take. Okay, here down it is given 2018. And particulars rupees they have given. Revenue from operations, other income, cost of material consumed, changes in inventories, employee benefits expense, finance cost, depreciation and amortization expenses, other expenses excluding interest and corporate income tax rate at the rate 35%. So this is actual question given, and from this we have to calculate the profit and loss statement as per the Companies Act 2013. So whenever like this question is given, remember the format has to be followed thoroughly and prepare. So first we start with heading, that is profit and loss statement. Who statement? Chetan N Limited. So profit and loss statement of Chetan N Limited for the year ended 31st March 2018. This is the state heading, we have to write it. Now, next what we will do, we'll draw a table. Table consists of particulars and note. First note particulars and amount in rupees. So you will draw like this. Serial number or note number. Next particulars. Next we'll have amount. So how, from where I'm going to write? You can have text book. Please look at the format given to us. Profit and loss statement format. It starts with Roman number 1. Starts with Roman number 1, and that is called as revenue from operations. Revenue from operations amount is given us directly. Yes, 5,200. Actually, that is 52 lakhs. In lakhs, they have given above. You can just look at here. This lakhs. But I'm writing, as they mentioned, I'm writing 5,200. That is 52 lakhs. Next. Next one is what? As per format, other income. So Roman number 2, other income. And other income is 650. So what was that? Total revenue, Roman number 1 plus 2. So 5,850. We close this. This is total revenue. Can write here total revenue. In the brackets 1 plus 2. Revenue means nothing but income. Total revenue. Incomes we have find out. Now let's see what are the expenses we have. What are the expenses? That is Roman number 3. It is as per format only I am writing. So you have to read the format. So Roman number 3 is expenses. Under expenses, what's the first one? Cost of material consumed given to us. Changes in inventory also given, and it is a negative figure. You can just look at here. Bracket means it's a negative figure, minus figure. And employee benefits expense. These all are expenses now. Finance cost and depreciation and amortization expenses and other expenses. So these all are expenses given to us. Add all this together. 2018, 28, 30, 40, 40, 60, 40, 60, 50, 50, 50, 5,005, 5,555 minus 125. So 44, 30 it will be. So these all are expenses. That is Roman number 3. Under Roman number 3, we write all these expenses. And from these expenses, we will deduct total income. So next we'll have profit before Roman number 4. Profit before any extraordinary items or not. That is 3 minus 4. And in this question, there are no extraordinary items. So again, we will have the, do we have any extraordinary items? We have yes, na? That is, no, we don't have anything like that. So this is 4, sorry, fourth one is expenses. 3 was total income. So 3 minus 4, that is income minus expenses, will get 14.20. And we don't have any extraordinary or exceptional items. And we have only one thing, that is tax. And tax is 35%. So 35% on what we will calculate? 35% on the profit we got before tax. So 14.20 into 35. It comes to 4.97. So when you deduct this, you'll get the profit, that is net profit for the current year. I hope that the same answer. Yeah. See, 4,497, 4,000. That is 497 means 4,97,000 it is. And this is the profit. That is 9,23,000. This profit will be transferred to the balance sheet in the shareholders fund, that is reserves and surplus. It will be posted in the, if balance sheet, if we are preparing balance sheet also, in that case, we'll post it in the balance sheet, that is in shareholders fund. Equity and liability is there in the format. In that, we will write it in the shareholders fund, reserves and surplus. This is how we prepare the profit and loss statement. And this is about all about block 2. Next, we have block 3 and block 4. Block 3 talks about the cost accounting and block 4 talks about the financial statement analysis. So first we'll move to the financial statement analysis, that is block 4. Yes, am I audible?
Yes, ma'am.
Yeah. So this is all about is finance block 2, and next we'll move to the first block 4. And the block 4 is about understanding financial statements. So we may get it out. What is new thing about financial statements? We are preparing already final account, that is balance sheet, trading account, profit and loss account, company form of accounts. What's new thing in the understanding what is this financial statements? Because as a common layman or the parties who are interested in the company or parties who are interested in the organization, who are the interested parties in the organization? The persons who have kept their amount or invested their amount in the organization, such as shareholders or creditors, banks who have given loan to the company, debenture holders who have given loan to the company, yes, and government who is keen about to change the tax rules and tax regulations annually, income tax department to collect the tax from the particular company or particular organizations or particular type of industries. So these are the people who are interested in knowing about our financial statements. So leave about all these people, specifically or especially I'm an investor, I invest in your organization. But by looking at the only your trading account, profit and loss account and balance sheet, as a investor or as a management of that organization, if I want to take any decision as a management of that particular organization, if I want to take any decision whether to continue in that project, whether to close that particular department or to close certain product, or shall we expand our organization, if expanded, where it has to be expanded, in where we are lacking behind, why we are getting less profit, why we are getting more profit, how do I know? Only by preparing trading account and profit and loss account, it is not possible to find actual or true or fair financial systems or financial uh, analysis. What it has done cannot be known. Then how to know that? Because only by looking at purchases, sales, we are showing, we are not showing department wise, we are not showing how many assets we have, we are just showing balance sheet, all assets and liabilities. And in that assets and liabilities, uh, so here in the balance sheet, we can only showing all assets together and all liabilities. But in company form, again, we are showing separately. Yes, that companies act as per Companies Act. We are showing separately that each head we have different assets, liabilities. But through that also, we cannot find actually whether the company is true or genuine or whether it's working properly or not. Then how to know to make our thing easy? To understand whether our assets are having current assets easily, whenever we require amount, can we able to convert easily into cash or not? Do we have that much sufficient or required assets or not? That are possible by preparing the financial statements. So in this block, we will try to understand financial statement analysis, ratio analysis, funds flow statement, and cash flow statements. So these will help the organization to know whether the company is having enough funds with it or not. What is directly in the cash it is available? What are the funds that are easily available to us? Do the company is in liquidity position or not? What is its profitability position? This all is understood with the help of financial statements. So now let us look at the financial statement analysis first. So in financial statement analysis, we know only one type of balance sheet. But here we try to understand comparative balance sheet, common size balance sheet, and trend analysis. Common size income statement as well as balance sheet, comparative income statement as well as balance sheet, and trend analysis. So let's look at that. So financial statement, they're given different meanings and definitions to us. So actually you can just look at here the two basic, or rather say two major financial statements which are required to be prepared for the purpose of external reporting to whom? Owners, investors, and creditor. These are the actually people to whom they should know what is actually happening in the organization. Are what they require? Balance sheet and income statement. They require balance sheet and income statement. Whatever we are preparing in block 2 is not sufficient for these people to understand actually what is going on in the organization. External reporting as well as for internal management also they require. Why? Because they have to take decisions. They need to control, regulate, reframe the policies and rules. So for that also they require, yes or no? Then how to know that? By preparing. Actually, in that we have three things. That is, comparative statement has to be prepared, common statement has to be prepared, and trend analysis has to be prepared. Now let's see, can see trend analysis under the materials used and modus operandi. See, these are the different financial statement analysis that has been followed, and through which it will help the management as well as internal and external is useful to them to find out whether to understand better, for better understanding these statements are prepared. That is, you can see here common size, comparative, trend analysis, ratio analysis, funds flow analysis, and cash flow analysis. So first in this unit, we will try to know these three things, that is comparative statements, common size statements, and trend analysis. Let's see actually how they are being calculated. Okay, it's very simple. So first we'll try to understand comparative statements. So here 2 years information is given. Whose information? Same company. For example, ABC company is there. ABC company 2 years information is given. Last year and current year. Now what we are doing? We are comparing. We are comparing what is our performance. Is it increased or decreased? If is it increased, is it the purpose of sales or is it purpose of, it is because of other incomes? If it is decreased, because we are having more and more expenses we are incurring. If so, how it can be regulated? So in comparative statement, we will compare our own company's information with that of last year. 2 or more periods information will be given, and we try to compare it with the earlier year with that of the present year and try to find out is it increased or decreased. So in that we'll prepare both income statement and balance sheet. Income statement is nothing but the profit and loss account. Income statement is nothing but the profit and loss account and balance sheet. So let's look at the format. If format is given, let's see, otherwise we'll go for the problem only. So here also it's very simple. For common size or comparative, they have given some format that has to be remembered or by hearted. So if you can just look at here, this is the format. This is the format you have to remember. Current assets, all current assets will be written. Next, fixed assets. Then comes liabilities. Under that again, current liabilities and non-current other debentures or long-term. This all comes under total liabilities under current liabilities. Then we have equity and share capital. And this is format you have to remember first. I'm not talking about this problem. I'm talking about this format. I hope this is visible to you all. This is the format you have to memorize. Remember current assets and fixed assets. All current assets will be written first, then will come and then fixed assets. Then we will come to know total assets. First, I'm talking about format, not about how it is done. Okay, I'm first talking. This you have to remember. This you have to memorize. And first, whenever we do, if it is a balance sheet, we write current assets, then we write fixed assets. All current assets total up, all current fixed assets total up, then we'll get total assets. Total assets is nothing but total current assets plus fixed assets. We'll get total assets. Next, similarly, we will have liabilities. Under liabilities, you can just look at here. Current liabilities, the first heading. Under that, all current liabilities. Again, debentures and long-term loans. Even you can write, we cannot write capital. Why? Because it does not come under capital. They are long-term liabilities, we can call them. And this is long-term liabilities. Current liabilities, long-term liabilities, and then we will have equity share capital and reserves and surplus. When you add these three, total current liabilities, total liability, that is long-term liabilities, and total liabilities. All together, three we will add if we will get the total liabilities. Because this will be there as it is in the question, nothing too much worry about this. Let's see in the question. Yeah, they given here. Just look. I think it's visible to you all. This is the question given to us. So first we should know the format. Format is very important in comparative balance sheet or common sense balance sheet also. So here in this question, current assets are prepaid expenses, stock, sundry debtors, bills receivable, cash in hand, cash at bank. So first we'll write Roman number 1, current assets. We will write all these things and we'll total up. Next we write fixed assets. Roman number 2, these all are fixed assets. Now total assets is completed. Next we move to the yes, give me a second. So this is about assets, and here liabilities. Under liabilities, current liabilities, they're given as their current liabilities, sundry creditors, bills payable. These are current liabilities. And these two are long-term liabilities. So here when you look at the format, here 1 and 2, this ends the asset side, and here liabilities, we have current liabilities, long-term liabilities, and for this actually they have not given any heading to us, but we write shareholders fund, that is equity, share capital, and reserves. Assets we have 2 headings, and liabilities we have 3 headings. Current liabilities, long-term liabilities, and this is shareholders fund. Only this, remember. Now actually what I have to do, just now I was discussing format. In comparative statement, what is the actual thing it will be done? As I said, 2 years information is given to us, 16 and 17. So just look at here. We have written 16 and 17. So what we will do, apart from the question given to us, we will add 2 more extra columns. We add 2 more extra columns. So here we have to draw 2 extra columns. Both this, here we will not have 2 sides. Whenever we prepare comparative statement, we will have only 1 statement under the one particulars column. So we write particulars column and 4 amount columns. 2016, 17, and here it will be increase or decrease column. The next column is increase or decrease column. Increase or decrease. And the last column is, or this increase or decrease column is also called as absolute change. Absolute change. This column is called absolute change column. And the last column is percentage change. Absolute percentage change. So what is absolute change? Here we will deduct, for example, what is our first item? For example, it is 6. We write 16 and 17. And if I take cash in hand, if it is our current current asset, so normally we will not deduct 16 minus 17. We will deduct current year minus previous year. Absolute change means current year minus previous year. What is our current year amount? 80,000. And previous amount is what? 20,000. So 80,000 minus 20,000, it comes to 60,000. It is a plus figure. Next, if you look at your current year, your bills receivable is 90,000 and previous year it is 1,50,000. So here current year is less and the previous year is more. So we get the minus difference, that is minus 60,000. So like this, we will write all the amounts. We will find out the difference, that is current year minus previous year. That is called absolute change. Then what is percentage change? Percentage change is nothing but absolute change divided by previous year amount into 100. So here absolute change formula I am telling. Percentage change, how do we calculate? Percentage change is equal to absolute change. You can write, if you can make a note, absolute change divided by previous year. Here previous year is which year? Yes. What is our previous year in this question? What is our previous year in this question? Here our previous year is 2016. So absolute change divided by previous year into 100. So what is the change of cash in hand? 60,000. So 60,000 divided by previous year value is 20,000 into 100. Like this, we will calculate the percentage for all. So here 0 zeros cancel, 2 ones are 2, so 300%. So here the change is 300. The percentage change column, we write 300. This is how we will calculate the percentages for all the things. That is what is called comparative statement. Whether it is balance sheet, whether it is profit and loss account. So to do this, first we should know format. Then we should write 16 and 17. And here it is absolute change and this is percentage change. This column is called as absolute change. Change means difference of 2017 minus 2016. And the difference, not 16 minus not 17. 17 means current year minus previous year. Current year is 2017 and previous year is 2016. So current year minus previous year. And this is percentage change, 300%. Now, so how to find it for percentage? Absolute change divided by previous year value into 100. Like this, we do the percentages for all the things, whatever we have written over here. See, if you can look at it here, we were having minus, so we will write in minus only percentage. Like this, we do for the total balance sheet. This is how we prepare the comparative balance sheet. And for every problem, it's not like that just we did the problem and left. For that, we even have to write interpretation. Even we have to write interpretation. And interpretation, what we will write, if you can just look at here, what is the improvement in the fixed assets? Is it increasing or decreasing? If it is increasing, what is the need? Actually, why it is increasing? Have you purchased anything or how? Or we sold anything? And how does we come to know? That all we'll write over here. In the form of interpretation, we can write fixed assets about current assets, liabilities, that is current liabilities. So overall, what is its performance? This is how we do the balance sheet, comparative balance sheet. Next, we go to the comparative income statement. In comparative income statement, again same, should know the format. Format is required. And here they're given us directly. You can just look at here. Like in the account form, they're given us sales, cost of goods sold, expenses, and net profit. So how do we prepare again? Same in particulars. So from where we are writing this is the format given to us. You can just look at the textbook. It is a format. Net sales minus cost of goods sold, you'll get gross profit. And from that, we will deduct the operating expenses, less operating expenses. Under that, administration expenses, selling expenses, if we deduct, that is total operating expenses. This is B, and this is gross profit A, and net profit is A minus B. Profit is A, that is gross profit A, and expenses is B. So A minus B will get the profit. This is how you will do as per the format. Then again here, same what we will write, absolute change, percentage change. Here also, current year minus previous year, we write it. Current year minus previous year. And current year is 1000 and previous year is 800. We find out the difference. And again, we do the percentage. How do we find out the percentage? This absolute change divided by previous year value into 100. So 200, current absolute change is 200 and previous year is 800 into 100 and try to find out the percentage. and try to find out the percentage. So this percentage is called percentage change. Same we do for this also. This is a compare, means we are comparing 2 years of information of our company. And doing only this is not done. We have to even write the interpretation. And in interpretation, we write how sales have been increased, if it's increased, how it is increased, if it decreased, how it is decreased. Next come, this is about comparative statements, income statement as well as balance sheet. Next we move to the common size statement. Here common size statement, what do we do? Here also they'll give the 2 years information to us. So the common size statement, balance sheet and income statement are shown in analytical percentages. And how do we do this? We assume sales as our base. So we take here what the only difference is here also 2 years information is given, but it is of not of same company. In comparative statement, we are doing of our own company 2 years with information. But in common size statement, we are taking information of 2 different companies. In common size statement, we are doing information of 2 different companies. So here in common size statement, 2 different companies, our company with some other company we are comparing. We are trying to comparing the figures of 2 different companies. Whereas in comparative statements, we are doing the comparison of our own company. So we know only how we are comparing, how we are doing, whether it's increasing or decreasing. But when it is compared to the market, whether are we trying to, are we are able to meet the, we are in the competition or out of the competition, that will be known only when it is done common size statement. So in common size also we do common size balance sheet as well as common size income statement. So here we have 2 different, you can look at here, 2 different information, S and company, K and company. So again, they given all preference share capital, equity share capital, reserves and surplus, long-term loans, bills payable, sundry creditors, outstanding expenses, proposed dividend, assets, land and building, plant and machinery, temporary investment, inventories, book debts, prepaid expenses, cash and bank balances. So if you look at here, we have preference capital, and from this, because first format is same as it is written for the balance sheet for comparative, same as it should be written. So here current liabilities are proposed dividend, outstanding expenses, sundry creditors, bills payable. These are current liabilities, that is Roman number. Under liabilities I'm talking. And here we have only one thing, that is long-term liabilities, and shareholders funds are preference share capital, equity share capital, reserves and surplus. These 3 are 3 different headings. Next, under assets, again we have cash and bank balances, prepaid expenses, book debts, inventories and temporary investment. This all comes under current assets, that is Roman number 1. And these 2, that is land and building, plant and machinery, are Roman number 2, that are fixed assets. Land and building, plant and machinery are 2 fixed assets. So these 5 are current assets, these 2 are current fixed assets. We'll add this. This is format, you know this, yes? Now, how it is done, let's look at here. So here we make same 4 columns. How we did in the comparative statement, similarly, we prepare 2 additional columns in the common size also. So in the common size, what are the additional columns we draw? See, in comparative statement, we have drawn after the 2 amount columns. But here that was same company. But here these 2 are different companies. So what to do here? After the company, we'll write percentage. And after the company, we write percentage. Then what is the percentage? What are we going to calculate? Let's see that. See the format we have written, amount we have written. Then how we are getting percentage? In the percentage, we take total assets as the base. So 4,38,000 is the total. That I will take it as 100 as base. So how do I find out the percentage for land and building? 80,000 divide, that is 80,000 means land and building is 80,000 divided by total assets 4,38,000 into 100. 80,000 divided by total assets 4,38,000 into 100. We'll get 18.26. Next, how do we do for plant and machinery? 3,34,000 divided by 4 lakh total. The particular asset divided by total assets into 100. So particular asset is what? Plant and machinery, 3,34,000 divided by 4,38,000 into 100. Similarly, temporary investments. How much? 1,000 divided by 4,38,000 into 100. You get 0. Like this, we will total respective asset divided by total assets into 100. We'll get the percentage. Similarly, for the K and company also. Here, what is that? Land and building, 1,23,000 divided by 8,08,000 into 100, 15.22. Similarly, like this, we do for the all the assets divided by total assets into 100, we'll get the percentages. Same for the, then how about balance sheet, liability side? In liability side, we take total liabilities as 100. So your preference share capital is how much? 1,20,000 divided by 4,38,000 into 100. 1,20,000 divided by 4,38,000 into 100. Like this, here also on liabilities, respective liability divided by total liability into 100, we will calculate it. Similarly, we'll do even for the income statement also the same way. The format will remain as it is. Here again, year, percentage, year, percentage, rupees, percentage, rupees, percentage. Then here, what will be taken as base? For here, the base is taken as sales. In balance sheet, we take total as the base. And in income statement, we take sales as the base. For example, cost of goods sold is 325. Then how to calculate? 325 divided by 500 into 100. 325 divided by 500 into 100. Next, 175 divided by 500 into 100. 20 divided by 500 into 100. Like this, total base is sales. Sales will be taken as a base, and for the remaining things, we will calculate the percentages. Is it clear? Yes?